It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. Jesse Livermore. Now here's the uncomfortable part. Most people are right about money. They work hard, they save a little, they avoid obvious scams, and they still don't get rich. So what's missing? It's not effort, it's position. Let's start simple. If hard work alone created wealth, construction workers would own private islands. But they don't. Here's the math nobody talks about. If you earn $60,000 a year in the US, after taxes, maybe you keep $48,000. Let's say you save 10%. That's $4,800 per year. Even if you did that for 10 years straight, that's $48,000 before inflation. Meanwhile, the S&P 500 has returned about 10% annually for nearly a century. $10,000 invested at 10% for 30 years becomes over $174,000. That's the difference between working for money and money working for you. Hard work creates income. Ownership creates wealth. What we're living through right now? It's not new. It's a sequel. In the 1970s, investors were obsessed with the Nifty 50, companies that could never lose. Some traded at 40 or 50 times earnings. Sound familiar? Today, parts of the S&P 500 trade above 25 times earnings. The top 7 stocks account for more than 30% of the entire index. 1/3 of the market in just a handful of companies. That's concentration. That's narrative-driven investing. That's history rhyming. Between 2020 and 2022, the money supply increased by over 40%. Your salary didn't go up 40%, but asset prices did. That's not a coincidence. Most people are stuck in the linear income trap. Time, work, paycheck, bills, repeat. Wealth doesn't work like that. Wealth is exponential. Ownership of productive assets, stocks, businesses, real estate, intellectual property. These scale. Your time does not. The top 10% own nearly 90% of stocks. Most people are working in the system, but not owning the system. That's the gap. There's another layer. Inflation. If inflation averages 3% annually, your money loses nearly half its purchasing power in about 24 years. So even if you're saving, if you're not investing above inflation, you're slowly getting poorer. It's like running on a treadmill that keeps speeding up. You feel exhausted, but you're not moving forward. And when markets look expensive, when P/E ratios stretch, when everyone's bullish, when headlines scream about AI replacing humanity, it feels like you missed the boat. That anxiety? History says it's normal. In 1999, NASDAQ traded at insane valuations. It crashed nearly 78% afterward. But the companies that survived became giants. Sequel, different cast, same script structure. Either everything is collapsing and you should panic, or everything is going to the moon and you should buy everything. Reality lives in the gray area. Markets today are not cheap, but they're not 1929 either. Yes, concentration risk exists. Yes, valuations are elevated. Yes, liquidity drives cycles. But innovation is real too. The lesson isn't panic, it's positioning. Hard work should fund ownership. Income should buy assets. Assets should compound. Risk should be managed, not ignored. You don't have to swing at every pitch. The goal isn't to get rich overnight. The goal is to survive long enough for compounding to work.